Hi, as I speak to you on the 10th of August, the Nifty is hovering around 10,300. At these levels, the PE ratio, the PE multiple is around 30. This means valuations are stretched, valuations are on the higher side. But it is important to remember that the valuations for stocks are on the higher side globally. Globally, stock markets are bullish. Even though the economies are in recession, the markets are bullish and the market valuations are high on the higher side globally. So at these high valuations, what should investors do is the most important question. Now, why are the markets high? Broadly, briefly, there are three reasons. One, the central banks, the leading central banks of the world have been injecting huge amount of liquidity, unprecedented liquidity, by following an ultra loose monetary policy. A part of this liquidity has come to stocks, pushing up stock valuations. Two, interest rates are at historical lows, and when interest rates are low, valuations of stocks will be high. Third, market expects the global economy to rebound, businesses to rebound, and corporate earnings to rebound in 2021. Of these three factors, the first two, liquidity and low interest rates, are facts. The third one, the expectation that the global economy and the markets will rebound, earnings will rebound in 2021, is an expectation. If the expectation goes wrong, the markets will correct. Or if the liquidity dries up, the market can correct. Or if interest rates start moving up, the markets can correct. Or because of some other reasons, the market can correct. So it is important to understand that the valuations are on the higher side, markets can correct, but when will the correction come? What extent correction will happen, to what extent the market will decline, and what will be the trigger for the correction? These are questions for which no one has clear answers. So important question is, what should investors do in this very complex, difficult, unprecedented times? First thing, we should learn from the history of stock markets. We should learn from the history of financial markets. The last more than 100 years of financial history tells us that stocks outperform all other assets classes in the long run. This is true of US, this is true of Europe, and in recent times, this is true of most emerging markets. Financial history tells us that wealth is created through long-term investment. In India, we know the Sensex was 100 in 1979. Now it is above 38,000. This means during the last 41 years, the markets have multiplied 380 times, giving a compound annual growth rate of more than 14%, 1-4. This is a decent beat over other asset classes, including gold, bank deposits, and public provident funds. So it is very important that investors remain investors. Irrespective of the valuations in the market, investors should remain invested for the long term. Then only investors can participate in wealth creation. So the question is, how do we remain invested? If you are an investor in mutual funds, simply remain invested. Continue to invest through systematic investment plans. You don't have to churn. A lot of churning is not needed. The fund managers will be doing the churn for you. On the other hand, if you are an investor in stocks, you are an investor in stocks directly, it is important that you remain invested in quality stocks, stocks which have got great growth potential, stocks which have great track record of corporate governance. And it's also important that you churn the stocks, because there can be a change in leadership in the market. Some stocks will do exceedingly well, Stocks which were doing very well in the past need not do well for the medium term. Therefore, some sectoral shifts may be required. Stock churning will be required. Let me give you some indications based on what is happening in the Indian corporate scene, corporate earnings, sectoral performance now. I'm doing this analysis based on the results of the first quarter of this financial year, April-June quarter. All the results are not out, but based on the results that have been announced, there are some clear indications. Let me summarize it for you. Which sectors have done well? Which sectors are suffering? Well, IT has come out as a clear winner. IT has come out totally unscathed, because in IT, work from home is more than 95%. Lockdown has not impacted IT at all. And also business is good in cloud, in automation, in other segments of digital. Business is doing well. And for IT, even now, relative valuations are not compelling. Secondly, telecom is the biggest winner in the current crisis, because telecom is one sector that has converted the crisis into an opportunity. Work from home has led to explosive growth in data, and therefore telecom companies are doing exceedingly well. Their profits are going to explode. Already it is increasing smartly. Thirdly, pharmaceuticals, after a long slumber of more than 5 years because of under ownership, poor performance, pharmaceuticals are doing exceedingly well. The world has become sick to a large extent. Millions of people have been hospitalized and are under treatment. Therefore, medicines demand has increased hugely. Pharmaceuticals are doing exceedingly well. On the flip side, hotel industry, travel, particularly aviation, tourism, has been impacted and impaired very badly. Entertainment like cinemas have been hugely impacted. Automobiles have been impacted by the lockdown, but automobiles are recovering now because of increasing demand. FMCG, it has been a mixed bag, but FMCG is likely to struggle going forward, because job losses, decline in incomes, and slack demand might impact FMCG going forward. So based on this sectoral analysis, let me share with you two major trends in the markets now. Which are these two trends? Number one, the leadership of the market is changing. The last several years, financials, banks and NBFCs, particularly financials, have been the leaders. The leadership is slowly changing. Telecom is emerging as a major sector. IT, it has been a major sector, but it is becoming stronger. Pharmaceuticals, even now, the market size is very low. The market cap is low compared to the financial, but it is emerging. So sectoral leadership is changing. So investors should take a cue out of that and do some churn in the portfolio if they are directly investing in stocks. The second major trend in the market is big is becoming bigger. To give you an example, HDFC Bank, if you look at the results the last quarter, it has increased its market share at the expense of others. Same is true of many other sectors. So big is becoming bigger. Sectorally, new leaders are emerging. So we have to make investments based on these sectoral trends and leadership changes. If you are investing in the mutual funds, the fund managers will do it for you. And now another major development recently is mid caps have started outperforming. But then mid cap can be a minefield, mid and small caps. Therefore, investors have to be very careful while directly investing in mid caps and small caps. It is better to invest in mid and small caps through the mutual fund route, ideally through systematic investment plans. By early next year, 2021, hopefully, the consensus is that the pandemic will be behind us. There will be some sort of normalcy. Economies will start rebounding, and businesses will grow, corporate earnings will grow. So smart investment, systematic investment, and patience will be rewarded in the long run. Thank you.